U.S. is ramping up its military efforts against the Houthi rebels in Yemen. And wow, this is really shaking up the markets. We're talking about vital shipping routes at risk here, which means global oil supplies could take a hit. That's a huge deal.
It is. I think what's really striking is how interconnected these actions are, with the ripple effects spreading far beyond the region. Securing those maritime channels is critical, not just for shipping, but for global trade and ultimately economic stability. Still, I can't help but wonder if this escalation is setting us up for prolonged instability.
Absolutely, Jenna. And you know what caught my eye? The market reaction. Brent crude futures jumped 0.6% after just the announcement. It shows you how sensitive these markets are to geopolitical turbulence.
Exactly. It's a classic case of uncertainty driving volatility. And when investor sentiment starts shifting, especially with something as foundational as oil, the effects can spiral quickly. I mean, energy prices don't just impact consumers, they influence inflation, corporate margins, you name it.
Right. And we can't ignore the potential for disruptions to the global supply chain either. You know, these shipping routes are such a lifeline. So when investors hear of attacks or potential conflicts affecting them, it's almost like a reflex. Markets react immediately, pricing in the worst-case scenario.
And what's consistent in these scenarios is the way markets amplify fears through rapid reactions. Brent crude's price spike is just one signal of how deeply intertwined geopolitical events and market psychology have become.
It really is fascinating. And it's not just about today's prices, but the sustained volatility we might see depending on how this unfolds.
You know, Ethan, sustained volatility like this really takes me back to historical precedents. I mean, think about the 1970s oil shocks. Geopolitical conflicts then had such a massive impact on oil supplies, leading to seismic ripple effects on inflation and the global economy. It's almost eerie how some of those patterns feel like they're surfacing again.
Wait, you're talking about the embargo, right? When oil prices quadrupled and the global economy practically hit a brick wall?
Exactly. That crisis was a wake-up call about how dependent economies were, and still are, on stable energy supplies. Fast forward to today, the market psychology hasn't changed much. The fear of supply disruptions alone is enough to send prices climbing. It's like a memory the markets can't shake.
It's wild. I mean, look at this 0.6% Brent crude jump. It doesn't sound huge, but in the world of commodities, that's, what, massive? It's like the canary in the coal mine for everything else that might come.
Exactly. And markets aren't just reacting to the present. They're preempting the future. What if the conflict escalates? What if more shipping routes are compromised? It's all uncertainty, and that drives, well, volatility. Investors are walking on eggshells.
Right. But here's the kicker. It's not just about oil, right? High energy prices trickle down. They hit transportation costs, manufacturing, even groceries. And if it drags on, inflation could tick higher globally.
True. And for emerging markets that are heavily reliant on energy imports, it could be catastrophic. We're talking crippled currencies, skyrocketing consumer prices. It all spirals. During the 70s, we saw similar struggles in, say, Latin America, where inflation ran rampant. Those same vulnerabilities exist today.
So, what's the takeaway? Are we essentially on the edge of another major economic shock?
That depends. The key is how prolonged the disruptions are. Short-term volatility is one thing, but sustained price hikes over months? That could reset the entire global economic equation. It's, well, daunting to think about.
And it's not just the numbers. Globally, businesses, consumers, and, even governments have to adjust. So, on a human level, these price shifts aren't just about Wall Street. They're touching lives everywhere. It's undeniable. These price shifts are touching lives everywhere. But here's what I'm wondering. Amid all this chaos, is anyone seriously working on solutions? Are there any real efforts to de-escalate the Middle Eastern tensions? Or is it all just political posturing?
Well, there are international diplomatic initiatives underway, but the progress, it's been slow, to say the least. Efforts by the United Nations and regional powers are aiming for ceasefires and negotiated settlements, but we're not seeing breakthroughs yet. And without buy-in from key stakeholders, these tensions are likely to persist.
Yeah, right. And while we wait for someone to patch things up, markets are on edge. Investors can't just sit around hoping for resolutions. They got to take action now. So, Jenna, what should they do? What's the play here?
It's simple but critical: diversification. In times like these, investors need to spread their exposure across asset classes and sectors. Maybe hold a mix of energy stocks, commodities, and even some inflation-protected securities. It's about creating a buffer for these wild swings in market sentiment.
Totally. Diversified portfolios can weather storms better than those concentrated bets. But let's get specific. Are there opportunities in these high-risk regions? Like, could investing during geopolitical turmoil actually pay off?
Absolutely, Ethan. There are always those willing to take on risk for potential upside. But it's got to be an informed approach. For instance, multinational corporations in energy or logistics often have the resources to navigate instability better than local firms. And then there's the renewable energy space. It's an interesting hedge when oil markets get shaky.
Interesting. So you're saying high risk doesn't always mean high losses. Investors just need to, I guess, think longer term and avoid getting caught up in short-term panic.
Exactly. And for anyone navigating this market, proactive risk management isn't optional. Investors should make it a habit to stress test their portfolios. What happens if oil prices spike further or if the dollar weakens? It's all about having contingency plans.
Makes sense. And I like that you brought up renewables because, every crisis kind of opens doors for change. This could accelerate those shifts to alternative energy sectors, right?
It could. Historically, disruptions like these often spark innovation or shifts in strategy. For investors paying attention, it's about spotting those trends early and aligning with the industries or technologies poised to benefit from the chaos.
And that's the key word, chaos. It's everywhere right now, so staying informed and adaptable is more important than ever. I mean, if the last few weeks have taught us anything, it's that markets move fast.
So true. And on that note, I think we've covered a lot today. The world may be unpredictable, but the key takeaway for investors is to focus on what they can control: their strategies, their knowledge, and, well, their mindset.
Right. And that's a wrap from us. Stay vigilant, stay informed, and remember, volatility doesn't have to mean fear.
Exactly. Thanks for tuning in, everyone. We'll see you next time on Rich Frontiers. Take care.